Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending July 12th, 2019. Well, I think the Feds spiked the punch bowl. More on that in a minute. But this week we've seen just about all the indexes finish in the green. The lone exception and holdout was the Russell. They're continuing to underperform dramatically over the past year and a half. The Dow was up about 1.5%, S&P up about 78 basis points. NASDAQ was up a little over 1%, and the Russell coming in the red for the week at 36 basis points down. We saw the VIX fall a little over 6%, 6.5, 6.6%, down to 12.39 is where we closed. I mean, just 39 cents above the 11 handle for the VIX. Last week we closed at 13.26. In the world markets, most of them were down for the week. The FTSE was down 24 basis points. CAC 40 was down 19 basis points. DAX was down 48 basis points. The Nikkei was down 8 basis points. And China was also down just under 1% at 77 basis points. So while the U.S. had a good strong week, with the exception of China, all the other markets really came down a pretty good bit. China also down too. The weekly performance by sector for this week, discretionary came in pretty good, a little over, almost just slightly under 2%, while the worst performer, materials, they came in a little under 1.39%. I'm looking at the forward PE ratio. For the markets right now, it's at 18.05. It's continuing to move up. Now, the trailing PE is at 23.30. So there's still about a 22%, 22.5% discount between the go forward PE ratio and the trailing PE ratio of where we've actually been. But we're starting to get into elevated territory. I don't need to remind you that going back to 2018, in January, we're not much higher than where we were then. Excuse me. And the PE ratio then was about 18.5. So we're starting to get into elevated PE ratio territory. All right. Now, speaking about the Fed spiking the punch bowl, excuse me, our very own Fed chair, Jerome Power Ranger Boom Boom Powell, came in and gave the market some more upside juice in his congressional testimony this past week. Why is it when I always start off our sessions I cough? Anyway, the congressional testimonial basically pretty much all assured the markets are going to see another 25 basis point rate cut. You know, that put us to the tune of about 100% probability of, I don't think I've ever seen 100%, but that's what we got, where the Fed Fund Futures is pricing in 25 basis point rate cut in the next coming couple of weeks when the Feds meet, and there is a 72% probability of another 25 basis point rate cut in their September 17-18 meeting, and astoundingly, a 55% probability of a rate cut in their December 10th, 11th meeting. So that would be 3 more rate cuts for the year. I just think, guys, that's way too optimistic. I could see 1 rate cut, and then I could see Boom Boom Powell going on hold for a while. But the markets have that priced in. And in my experience, keep in mind that whenever there is that many rate cuts built in and the markets are overly optimistic, that is an area where we can expect downside price action if we don't come into this. This is going to continue to build asset bubbles in the markets, as money goes in search of yield. But even with all of this past week, we reached new all-time highs. The Dow topping 27,000, S&P taking out the 3,000 level. We saw NASDAQ making new all-time highs. So this human greed creates a lot of this FOMO, the fear of missing out. Upside price action where it can just take on really an aggressive move up before, I guess, more rationalized longer-term fundamentals start to move the market back down again. I mean, we only need to look back to 1998 when Greenspan coined the term irrational exuberance, and he was cutting rates at that time. We were in a strong bull market, but we had some issues overseas, and the long-term capital, they had to come in and rescue that. So he cut interest rates, and then it only took a couple more years for the party to keep on going until we had the bubble burst in 2000. And the bubble's going to eventually burst here as well. But I think we could still see some more upside before finally giving it up. And I saw this quote from a mobster in The Godfather. I remember Hyman Roth. He said, this is the business we've chosen, and it's up to the investors to deal with the rigged game, whether they like it or not. So for us, no matter how much logic would say, you want to be careful here, we got to play the upside because interest rates low like this is just going to force money into the long side. And this game is going to continue on for a while until we see the time for us to get out. So that's what we're going to do, and we're going to continue to play these long moves. It's been well for us. We've seen GDP growth this year come in the first half of the year at only 2.3%. On average is kind of where it's going to be, I suspect. And we're going to finish the year around 2.1%, well off the Q1 strong number that we got. But that's the estimate that we're going to see. Um, so this is kind of the first time we're seeing the Feds actually take a proactive stance and cut rates while markets are making new all-time highs. Now, they haven't officially done it yet, but Boom Powell kind of officially in front of Congress this past week, all but assured a probability of a rate cut, coming up the end of this month. So short-term price action, I think it's going to be a little bit mixed, but it's leaning to the upside. We're going to see some pullbacks. I'd like to see a 2.5 to 4% pullback, but I still believe we're going to see some more upside, as I'll show you here in the charts in 1 minute. But this self-induced artificial lower interest rate market, as I said, is going to force larger money funds into higher yielding assets, more risky assets, and that in turn is going to create more of a FOMO market as more of it kind of jumps in. And as usual, the rat brain retail trader is going to be the last to jump in. Now, we got an interesting scenario kicking off this next week. I mean, this is when Q2 earnings are really going to officially kick off. 56 companies are going to begin their reporting this week, and it's going to be a very strong week for banks. We got JP Morgan, Wells Fargo, PNC Financial, USB, Capital One, Morgan Stanley, Citigroup. We got Goldman Sachs. I mean, that's a wealth of bank stocks coming out with their earnings this week. And of course, we got a lot of other key companies coming out this week as well. It's going to be very active for economic data. We're going to get June retail sales, residential construction. We're going to see some consumer sentiment, regional manufacturing data from New York and Philly. So it's going to be a very, very active week. Now, just looking at the analyst projections right now, for Q1, earnings per share had a year-over-year growth of just 80 basis points. That's 0.8%. The consensus for Q2 is for earnings to actually drop 2.7% year-over-year from Q2 of 2018. We're going to see how this does, but should earnings come in very poorly, I want to watch price action to see how it matches up with the Fed put, right? See who's going to win. I mean, the Fed put essentially where they're very accommodative with lower interest rates to keep asset prices elevated. Let's see which one wins, the Fed put or lower interest rates. I mean, lower earnings per share. Now, eventually fundamentals take over, but near term, we can always see it FOMO higher. What you see on the screen here is the chart of the S&P 500 E-mini futures. You can see we hit my target, both time and price, with this colored bar here, which was perfect. I had this target up here when we started the pullback in May. I was having our members putting on what we call our FUBAR hedges. That's effed up beyond all recognition. That's what I call them, our FUBAR hedges. So we were putting on our hedges in the market in late April, and then the timing worked out very well because we pulled back. And I was showing our members how to actually put on a hedge where you can make money in the hedge even if the markets go higher. And that's what we were doing. But obviously for us, the markets fell lower, so we were making money in our FUBARs. And now we've had this V correction. We came right back up, hit my target right here, a little over 3,000. If you'll notice, there's another bar up here even higher, around 3,100. That's a longer term target I have in the S&P. I do believe we're going to hit it. And you can see there's no divergences here at all. So the value area here, because we've just really had a really fast run higher, the value area going back a fiscal quarter or 90 days is roughly about 28.82. We've kind of accelerated away from that. I think we're going to kind of run sideways a little bit. And if earnings come in and forward guidance comes in worse than anticipated, because we're elevated with PE ratios and everything, I think the odds favor the markets to pull back a little bit. Okay. And of course, if we look at NASDAQ, it's been on fire as well. You can see we're slightly below my target for NASDAQ. We hit 2019 and all-time highs as well. My target for NASDAQ 100 futures is right or a little over 8,080.65. We're pretty much right on target with that. Again, no divergences, so this tells me any pullback is probably near term going to be bought. And then, of course, if we look at the Dow, the same thing with the Dow futures made all-time highs. You can see it really finished with a strong flourish this past Friday. We were up at 27,330. Again, hitting my target. My target was 27,118, and we came in at 27,330. Again, I think and this is my longer term target for the Dow, which is a little over 28,000. Okay, when I say longer term, I mean just this year. That was my target for the Dow. So I think we're going to get up there. It's not going to be a straight shot, but that's kind of where I see us going right now. Okay. Now, the one thing that gives me pause is if we look at the Russell, and look at the Russell futures. We are not even at 2019 highs, let alone all-time highs. All-time highs or way up here that were made last September. So we're well off the numbers. In fact, if I step it out, let's go back, put it on a weekly chart, and I take all of this off the screen. You can see here where we were. I mean, look at this, right up in this area right here. This was back in September. And then boom, we're nowhere near that. We're kind of sitting at the 50 percentile level, maybe a little bit more from the Q4 debacle where the markets just crashed. So that tells me we need to be very concerned here. We're not getting participation in small and mid cap stocks that I would like to see to get this market moving higher. Okay. You can see here in this kind of stepped out view on this weekly chart of Russell futures, we're not even at 2019 highs. Okay. Now, if I put it on a daily chart, the other thing I want to show you here in the RUT futures, the 50 is still well below the 200 EMA. Okay. The value area here is sitting right at 1561. We closed the week at 1572. So we're just slightly above the value area, slightly above the 200 EMA. We do not have any divergences on here, so it does suggest that any pushback here in the market price is probably going to be bought, but we're just severely underperforming. I mean, it kind of looks like, and I was talking about setting up a pair trade where you go long the Russell and you short the S&P. So you're just playing the difference or the divergence between the two. My target for the Russell was around 1634. We hit 1621, so we didn't quite get there. Could we kind of grind back higher? Yeah, I think that's kind of what we're going to do, but it's severely underperforming. And if we look at emerging markets, you can see here emerging markets are up. Emerging markets love a weaker dollar. You can see the 2019 high right here. And you can see kind of where we're sitting in this market. So anything below this blue dash line, we would move into the red in emerging markets. So it's been moving up as well. But it's just not as strong as the U.S. markets. And of course, if we look at the tracking stock for China, you can see here it's the same thing. They all look like the Russell. 2019 highs in China were made back in early April. Okay. This does tend to suggest this Elliott wave pattern that we're going to move higher, but China has just been severely underperforming this year. All right. We get Chinese GDP coming out on Monday after markets close, I suspect. So we're going to get a good idea. The consensus estimate for Chinese GDP for Q2 is to come in at 6.2%. And that's down from their 6.4% first quarter GDP number. So China is continuing to slow. Obviously, these tariffs aren't going to have, or they're going to help it. So it's going to put some downward pressure on overall global markets, especially emerging markets here. Okay. If we look at volatility Volatility is well into the green. We're in this green zone, so that just means different volatility strategies that I like to play when we're in the green. All right, so generally anytime we're below 15 roughly on the VIX, you want to be long delta, I mean long gamma essentially. You don't want to be short because the odds favor volatility to move higher. So it just changes the nature of some of our option strategies. And for those of you that are not in our group, our option masters is just doing great. I'm covering a ton of strategies in there. I'm going to come out with a series of videos on it and post it in the YouTube channel so you guys can just get an idea more about what it's doing and why it's so popular. But you can see the VIX closed the week at 1239, so just slightly north by 39 cents of a 11 handle, which to me just amazes me. And if we look at the front month vol skew, or we're in contango, you can see we're in the green, so we're in contango, so we're down about 73 cents. So that just means the front month vol futures, which is July, is going to expire this Tuesday, and the VIX futures front month have to equal each other upon expiration. So it's going to probably keep a bid under VIX and pull the VIX futures in a little bit this week, but they've got to equal. And if we look at the back month vol futures, which is July and August, I mean, look at this. I mean, we're going into the summer months and we're well into a contango term structure. We're down here. So this just says the July vol futures is 2 full points below the August vol futures. So that's just a very steep contango skew term structure, which I don't think we're going to be able to maintain, but you can see it here. So it's really amazing. That would suggest that we're going to see some volatility come back into the markets, guys. Of course, if we look at bonds, you can see here. Now, this was an area with our members. I don't think I mentioned it here, but for our members, I think I may have mentioned it here, give you a freebie, where I was suggesting we pick up some puts in TLT, and it turned out to be we had a trigger right over in this area here, pick up some puts in TLT or short bonds, because it was a high probability trade up at this level here. You can see how our bonds is catching the 50 EMA. The value area in the bonds is sitting around 154 and 23 ticks. So we could run back up to that area again. I think bonds interest rates will kind of come back in just a little bit, and we'll kind of see where this thing settles in here. But I don't think bonds are done to the upside, which would mean interest rates are not done to the downside. And speaking of interest rates, if we look at the 10-year, you can see we're at this level right here. The huge value area is right around this 250 area, which was my original target. But we just blew through that and went all the way down. We actually broke the psychological barrier of 2%. There's another value area sitting right below us at about 2%. All right, so we're kind of sandwiched between two value areas, one at 2 and one at 2.5. All right, and we're sitting at 2.1. I think it's going to roll back over and come back just a little bit interest rate wise. Okay, of course, if we look at the currencies and we look at the dollar, you can see here, if I just kind of step it out, this regression channel with the dollar, it is moving higher, but you can see all of the chop in this. I mean, just a ton of chop, right? And every time we get to the top, I would recommend going long the euro, short the dollar. Every time we get down to the bottom, do just the opposite. Now we're kind of in the lower quartile of the this channel right here. All right, you can see kind of where we're sitting right here. I think the dollar is going to go higher, believe it or not, because all the other countries, money is just pouring into the U.S. right now. Even though all the other countries' interest rates are very low, which is kind of part of the reason why money is pouring into our country, which is keeping the dollar propped up, actually. Of course, if we look at the euro, it's going to be just the opposite of this. You're going to see the euro just constantly moving lower, right? Look at this regression channel right here. We've moved from around $1.20 right up in this area right here, $1.19 to $1.20, down to this low right here. So we're just the opposite. I think the euro is going to kind of once he gets up in this area, we've been making a series of lower highs, lower lows, and that's what I think is going to continue here for the near term. All right, unless the central banks do something to control it. The yen is kind of the global risk off indicator, risk indicator for global risk. And you can see here, we've just been making higher highs and higher lows. Very simple, okay? And we're having this little bit of a pullback at right here. If we break this level here, I think the yen is going to come down a pretty good bit. There's a value area here in the yen right at this area here. So, but there has been no divergences here at all. That suggests any fall off is probably going to be bought. This would be a buy signal right in this area here to go long the yen. Okay, so that's a little bit about what I'm seeing there. And of course, if we look at oil, oil is settling in. There is a lot of risk with the Iranian situation in the Persian Gulf, as well as the OPEC cuts. And you can see oil is kind of settled in the 60 area. My value area for oil has been anywhere from 57, 58 down to 54. So I kind of place it right around the 55 areas. I've been telling you guys for quite some time. But when we get these geopolitical events, it always tends to boost the price of oil by a couple of dollars a barrel. And that's what we're seeing right now. Okay, so you can just see if I step it out and we go take a look at a weekly chart, and we just kind of step out a little bit, you can see here just kind of where oil has been and where it's going. We're coming right back up. We'll probably test this area again in the middle 60s. Should it get pretty worse, and then I think we'll probably come back down again. All right. So that is where we're sitting with oil for the moment here. Remember, oil right now is kind of it's got a number of factors pushing it down and several pushing it up. Those that are pushing it up are more temporary in nature. The Iranian crisis in the Persian Gulf has probably put a $1 or a $2 premium per barrel price on oil, as well as the OPEC price cuts. They're keeping the scarcity here, but the IMF just came out and announced that global demand for oil is going to continue to slow. So that's going to kind of keep a pressure cooker on this. You could see on this daily chart, we're sandwiched between two value areas, one at $62 a barrel and the other sitting at about $58 a barrel. So we're going to kind of dance between these two value areas here, and they're almost equally as strong, all right, going back the past 90 days on this chart. So I think we're going to just chop around here for a little bit in the oil markets. If we come over and look at gold, gold pretty much did what I said it was going to do, guys. For those of you that took the trade, especially for our members, we were right on top of it. If I back step out, you're going to be able to see here, how we broke this. I remember I put in here 1410 for oil or gold, and we're sitting at 1417 right now. So we came up, hit my target, which now once we hit the target, we're going to get some chop. I think it's going to be able to climb higher, but not without some chop, maybe a little bit of pullback. Even on this weekly chart, there is no divergences, as you can see. So any pullback is still going to be bought in the gold market. And if we come look at the daily chart, you can see here the strength of that move. Once we broke out of this level right here, let me just get this thing set here. I don't know why it does this. But once we broke out of this level right here, that was a key break. I said, once we break it, we're going to run really fast. And sure enough, in just a few days, we went from 1372 all the way up to 1443, 70, 80 point run in about 3 days, 3 or 4 days. And that was a quick trade for our members that were able to just, put a contingent buy order in, a long order in around 1375 and just let it sit, and boom, away it went, right? So great run, about $5,000 per contract for those of you that took it in the futures market. And then getting out of it, setting a stop, having a trailing stop, follow it all the way up. Now we're in this chop, and we're going to be here for a bit, all right? Remember, gold likes lower interest rates because it tends to lower the dollar, which strengthens gold. And as long as the interest rates are staying relatively low, money seems to pour more into gold. Okay, so that's kind of what we're sitting here. The other one that I want to go short this thing. We made higher highs here from here. Remember, we took this short over here. We had members making $20,000 to $30,000 per contract in a 3-day period. So we made higher highs here, but I don't have a trigger on any of this. So any pullback here, I'm waiting for it to pull back and then see the last bout of buying come in. And then I'd be more than willing to take a short in palladium. So that's something that, we're looking at. course, we've got some things that we're looking at in agriculture, in meats. We had our short trade. I think I even gave you guys, you free members here on this thing, a chance to play in our, when our pigs fly market. Pigs can't fly, obviously, so we shorted lean hogs and did really well in that short also. I called out something in coffee, I think I did for free for you guys as well. That turned out to be pretty good. Now, for our members, we're going to be meeting this Sunday evening. We'll go through, all these major markets, but we'll dig into some stocks as well that look pretty good to me. And then we just keep in mind we got earnings coming up. And as I said, we got 56 companies reporting. Next week's going to be very strong for banks. JP Morgan, Wells Fargo, PNC, USB, a regional bank, Capital One, Morgan Stanley, Citi, Goldman Sachs. Oh, I left out American Express. They're coming up too. So it's going to be a really great week for that. It's going to be choppy. For our members, we're going to put on our Gator trade on Monday. You guys know what that means, chomp chomp. So it's going to be a fun trade. Our Gator works out really well in these kind of markets. So if you're not a member, I highly encourage you to come in and check us out. Just one or two of our trades, just one of our trades will cover your annual fee here. It's pretty cool. All right, guys, have a great weekend. Members, I'll see you this Sunday night. Take care, folks. Ciao.